You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Bootcamp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. Old trading walks into a bar. New trading raises it. Unlike some guys, Tastytrade puts traders first. Maybe you're the type to hunker down on your desktop for hours. Maybe you breeze by on your browser. Or maybe you just need that top-rated app right by your side. However you do it, Tastytrade's got the most advanced tools you need to tackle stocks, options, futures, and more, all in one place. Chart your heart out with over 300 indicators. See opportunity differently with interactive curve analysis. Use backtesting to learn from the past and plan for the future. The platform is only the beginning of better trading. You'll also find low pricing, lots of education, and backup from a support team that really gets how traders trade. It's no wonder Investopedia named Tastytrade the best broker for options in 2024. Genius loves company. Go to tastytrade.com/ride-with-us and see for yourself. Tastytrade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Fall in boot. It's time to get into peak options trading shape. It's time for Options Bootcamp.
All right, everybody. That music means we're back. It's Education Wednesday, and man, it is a jam-packed Education Wednesday. Hope you're strapped in if you're hanging out in the pro and ready to roll, because we got not just one, not two, but three shows coming at you today. It's a triple header. Education Wednesday, of course, kicking it off with the old OBC, good old Options Bootcamp. Then coming up a little bit later after this program, we'll dive into futures on the old futures rundown. And that's not enough, lest you not be sated with two programs. They're coming back a third time, rolling out the pro Q&A hot seat exclusively for our pro members. Going to be joined by Scott Bauer to tackle all of your options and just related questions out there. Vol, you name it, get them in now. If you haven't gotten your questions in now, make sure you get them in for that pro Q&A coming up. So a triple header coming at you today if you're hanging out in the pro. Remember, if you want to join the fun for yourselves, only one place to go, theoptionsinsider.com/pro. Might want to do it soon. The week ends on Friday. That's, of course, when we'll have to tally up the winner of the February Pro Trading Crate. Trust me, you want to win one of these bad boys. So get on in there, theoptionsinsider.com/pro. Also get your options oddities, the exclusive pro podcast feed, the fun community we have having a ball out there, the giveaways, all sorts of fun. Check it out over there on the pro as we go around the horn and see who's joining us on the old Options Bootcamp program today. First, we go out to the options mecca, known as Frankfurt. I have to say, I ran into some people just randomly this weekend who were from Frankfurt, and I tried to describe to them that Frankfurt was indeed the options mecca, and they looked at me blankly like I was a crazy person, which is the appropriate response to that insane suggestion. Nonetheless, we are joined from the options mecca known as Frankfurt by the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show, sir. What do you think about your fellow Frankfurtians dismissing the notion that Frankfurt is the options mecca, sir?
Did they look at you like you're crazy before or after you asked them that question? Because if it's before, it's perfectly logical.
It was after, and it was completely in response. And then I said, do you know the legendary Dan Passarelli and the hallowed halls of MTM, known as MTM, around the local haunts? And they also looked at me like I was a crazy, and then ran away screaming, I should add, once I mentioned your name. So it was an interesting interaction.
Excellent
Out there. And we are also joined, speaking of interesting interactions, it's been a while since we've interacted with this fellow. But we are joined once again by Mr. Jermal Chandler, now the head of options strategy over there at tastylive. He hasn't joined us on the network since November 8th of 2023. It's been a while. Jermal, welcome back to the network. Welcome back to the hallowed halls of Options Bootcamp, sir.
I can't believe it's been almost 2 years. It's crazy that time goes by so fast. And head of options strategy just means I like to trade a lot, really, is what that means.
Hey, then you're on the right show. We got the right guy. As we keep on rolling, right on into a little bit of the old options drills.
Well, in bunch, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
So festive here on the show. It's always Flag Day, always the 4th of July here on the old Options Bootcamp. Ready to roll out some options drills. The portion of the show where we take maybe another look, maybe do a deeper dive into an option strategy or concept. Explore some ways you should be utilizing it, how the pros like to do it, maybe some tips or tricks for approaching said strategy. And today's options drills was very much inspired by a listener question, as well as our conversation with Jermal's cohort over there, Mike Butler, on the show last week. We went deep into stock substitution. This was inspired by this question we got last week from Tatsu, I believe the handle was. He asked, where are we, I should say, on stock sub as the go-to strat for 2025? How do you like to set them up? This kind of kicked off a little bit of a conversation about stock substitution. I did mention we have an episode 280 from March of last year. You can go back and take a look at that one as well if you want. It's called, appropriately enough, Another Look at Stock Substitution. But after our little bit of a conversation with Mike and him throwing out yet another interestingly named strategy from you tasty folks. You love coining a good options phrase over there. It seemed like it was time to revisit this. I thought it was a good time to go in. Jermal, we'll get into your fun zebra in a second and all the goodness therein. But let's play one of my most favorite games here on the program, which is just word association. Whenever I ask Dan something like this, he always associates it with some sort of day drinking metaphor. But I'll ask you, when I say the term stock substitution, sir, what leaps to mind for you?
Well, I mean, what leaps to mind for me is probably just the deep in the money long call.
And Jermal, day drinking aside, sir, when I ask you to play the same game, the word association game, what leaps to mind to you, sir, when I say stock substitution?
Well, I would say initially, I can't believe that some people have so much risk at play with having that much stock in something. And yeah, I would have to agree with Dan. A deep in the money call for sure would be the answer for me.
All right, let's walk through some examples. We know we have new listeners all the time. Again, I do encourage you to go back and check out the archives. Check out episode 280. We've done a few stabs at stock substitution in the past, but new folks coming in all the time, and it's also worth revisiting, especially in light of the interesting strategy we're going to get to. And there's many different ways you can carve up the stock substitution onion at the end of the day. But let's go for a basic example. Everyone's favorite. I don't know. Can we even use... Dan, is it legal to use XYZ anymore now that the bastards over there at Square have stolen it for themselves, sir? We need to have an industry-wide collective lawsuit against them. That is unacceptable as far as I'm concerned. We have to go back, change all of our examples now. You know, it's a family-friendly show, but I'm thinking of using some more dire words for the folks over there at Square. But nonetheless, we're going to use XYZ. No, we don't mean Square, listeners. Trading for $100. You're long a decent-sized position. You got 1,000 shares of this bad boy. So you're sitting on, as Jermal alluded to, a lot of capital at risk here, 100 grand worth of XYZ. That's enough to make anyone think, I don't know, maybe I don't want to ride all this risk all the time. Maybe you're still bullish on this stock over the long term, but maybe you're worried about some near-term hiccups that might cause you to have a little bit of concern. Maybe it's just rallied for a while and you're sitting on some profits and you think, you know what? Maybe I don't want to keep all this at risk, but I still want to play. I still want to have some skin in the game. A couple of different things you could do. Option one, you can just do nothing. Obviously, keep your stock and ride it. It goes up, you're happy. It goes down, you're sad. Option number two, you can go out and buy a put and hedge. We talked about that a million times on the network, all the pros and cons of that. If you're interested in that, go into the archives. There's a million different ways we've discussed that too. Option number three is what we're going to talk about today, the old stock substitution. And it is exactly what it is implied in the name. You are going to substitute the stock with an in-the-money call. So you're going to sell the stock. That already could be a deal breaker for some folks. If you don't want to have the tax hit of selling the stock, then maybe this strategy is not for you. But that is step one. You're going to sell the stock. Then you're going to turn around, and that's where the devil is in the details, and that's where it's really merits a full options drill segment, because there's so many different ways you can do this. Usually it means picking up a longer term, as Jermal and Dan said, in the money call. But again, that's a huge subjective range. Do you go 6 months? Do you go a year? The way I tend to term it is you're going to go out at least 6 months. 6 months or longer is usually your working MO for a stock substitution. And then how in the money you go is up to you. I usually like to say at least 65 delta. So obviously you're going in the money, you're going north of a 50 delta. How far north, how far in the money, how far out in time? Again, that's all up to you. It's all based on how much premium you want to spend. And there is definitely a sweet spot. You go too far out, you go 2 or 3 years, you're obviously spending a lot of premium that you probably don't want to shell out at the end of the day. You go too far in the money, same thing. It's like you're replicating buying stock all over again for no real reason. The whole purpose of this, listeners, is to free up capital. So let's say in our example, you buy 10, because remember, you want to cover your shares. You buy 10 1 year out, so pretty far out, 80 strike calls. So there are 20 handles in the money. In our example, there's $10 worth of extra juice on them, extrinsic value. So your net outlay is $30,000. So you could see a bunch of pros to this already. You had 100 grand at risk. Now you've swapped that for effectively 30 grand. You've already freed up $70,000 worth of capital. If you're skittish, if you have a little bit of risk concerns, you can just put that into cash, and there you go. You still have most of your upside, and your rest of your capital is free. Your second benefit is you're putting the Greeks to work for you. Remember, there's no real Greeks other than Delta and stock. Stock is a Delta 1 asset. But you get into the options now. You have volatility, you have Vega, you have Theta, you have Gamma, all these things working for you. Remember, the worst case scenario is this same thing as if you own the stock. If the stock plummets. In that scenario, A, you only have 30 grand at risk to begin with. B, you have a delta to these calls. As the stock drops, of course, that delta is going to decrease. Your rate of loss is going to decrease. And then C, as the stock drops, the vol tends to pop. So the long Vega component of your long-term call is going to increase. Again, offset some of your losses. So the Greeks are working in your favor in this scenario. If it moves to the upside, if you get the positive outcome, then you're going to miss out on a little bit of initial upside. Remember, you don't have a full 100 delta call. In our example, let's say it's probably around an 80 delta. But as it continues to rally, that delta is going to increase. And pretty soon, you are participating at effectively 1-to-1, effectively a 100 delta option. So there's a lot of benefits there. The downside is, if the stock sits here, obviously, in addition to dropping, obviously, if it drops, you will lose that 30 grand or most of it. If the stock just sits here, though, remember, we didn't just pay the 20 grand, the intrinsic value. We spent 10 grand in addition. That is extrinsic value. If the stock just vacillates around here for the next year, that 10 grand is out the window. So now you've dropped 10% of the value of your underlying and gotten nothing for it. So that is one of the potential downsides of this. Again, there's multiple ways to carve this up. Let's go around the horn, get everyone's thoughts. Jermal, what are your thoughts on that kind of plain vanilla stock substitution? And also, when you're setting one of these up, how do you like to set it up? How far out do you go, and how far in the money would you like to go?
Yeah, so I really like doing this type of situation because, again, you have, like you laid out from the outset. I mean, if you had that $100,000 worth of stock, I just feel like that's a ton of risk. And so to be able to parlay that into 30 grand of risk versus the initial risk is so much better. And it frees up capital for a bunch of different trades. And like I said at the outset of the show, I love the trade. So I always have different ideas that I want to explore, and having extra capital is such a nice thing. Not to mention having capital, even if you don't deploy it right away, having capital on the side is always nice because you just never know when you get downturns, that in the market, right? And so I just think it's so much easier to do that. And I like to lay it out. I will typically go about a year out, maybe sometimes two. It just depends on how much I like the idea in general. But going further out, and I do typically go for probably about a 75 delta option. 75 to 80 delta option typically for this situation. In this case, obviously, we're talking about calls. So I think it's pretty straightforward as far as the amount of capital that you can use, as opposed to initially having 100,000, having 30,000 is so much better. And the ability to deploy capital in other ways, or just hold on the sidelines for better opportunities, I think makes sense.
Mr. Dan, same question for you. Plain vanilla stock sub, how far out in time are you going? And typically, how in the money are you going?
Well, for me, Mark, it's a balance of a few things. The most important thing is, how much time do I need? Is this a 1 month play, or is this like basically a long-term investment play where I want as much time as possible? So that's the first criterion. The second one is kind of a balance between this. Like, I want to go probably as short term as possible within the time constraint that I just described. And I want to do as high a strike as possible with the objective of having the tightest markets and least time premium. So, you kind of have to go and do this balance. Like, hey, if I'm, paying $2 of time premium here, but the markets are pretty tight. Okay, I like that, but that's only a 65 delta. I really want to go more in the money. Okay, I can go down to this 85 delta, and there's 25 cents a time premium. So that's great. Not really losing any time premium. Don't have much theta to worry about, but the markets are super wide. So I'm leaving too much on the table there. So it's a little bit of a balance there. That is, that's basically the main thing for me. Yeah.
All right. Now let's keep carving up this onion. That's plain vanilla, very straightforward stock sub. As you can see, even in that scenario, there are a million different ways you can approach it. You ask 10 different options traders, they're going to give you 10 different answers for how they like to approach stock substitution. But now let's go one layer beyond. Let's peel that onion a little bit further. Let's go out to our good buddy, the options guy, Mr. Brian Overby's favorite, the fig leaf. He claims this name was coined by one of his users, over there back in the Ally days, or on optionsplaybook.com. Because you're really only partially covered. Other names for this are synthetic covered call, all sorts of names for this. But this is a way to turn that in the money stock sub, not quite up to 11, let's say maybe 10.5. So let's go through the same example before. Everything else is the same. You have all of that money, that capital. You're going to swap the in the money stock. All that is the same. You're going to do all that the same. But now you're going to incorporate another layer to it against that long-term in the money call that you bought. You're now going to turn around and write what were typically monthly. We'll revisit this in a second, but monthly out of the money calls, effectively just like a covered call, just like if you own stock. You're going to turn around and sell an out of the money covered call against it. Again, that's going to be up to you how far out of the money you go and all the different subjective areas you can do. The goal for this is exact same as if you are doing it as a covered call. You're going to try to get some premium to offset. In the case of stock, you're trying to get just an income stream. In this case, you're trying to offset the premium that you just paid without giving up all of your upside at the same time. So this is going to give you a little bit more flexibility if you do it monthly or even more near dated, as opposed to doing it all in the same month, as opposed to buying the long-term in the money call, let's say out a year, and then selling the call in the same year. Some people like to do it that way because it's just easier to manage, but then of course you're not maximizing the theta. You want to get more near data that's going to maximize your theta decay, which is the goal at the end of the day of all income strategies. So let's say in this case you're doing monthly calls. That gives you a chance to revisit this strategy every month. And if the stock rallies, guess what? You keep rolling that strike up, or just keep doing that call. If the stock drops, you can let the call go out worthless or close it out. There's a lot of things you can do to adjust this strategy on a monthly basis that you can't do if you just set it and forget it 1 year out. And the goal over time is that theta is going to offset a substantial portion, if not all, of the premium that you spent for that call. I did want to pull up some real world examples. I just happened to grab one off my screen right before the show. And not my ideal candidate for this. If I would probably go dig for a deeper, more expensive stock. But this happened to be on my screen at the time. I was looking at some Portillos. We all know we've been talking about that on our Options Oddity show of late. Again, a cheaper stock, so you might want to just buy the stock. But let's say you weren't. Let's say you wanted to go out a little bit. Let's say our barometer was at least 6 months. So we're going out to August expiration. Portillo's was trading about $14.50 at the time. You could bought the 13 calls for $2.75. So you're talking about $1.50 in the money, $1.25 worth of extrinsic value. And now you could just let that ride for the rest of the year. All the pros and cons we just talked about apply. Or you could turn around and in our case, sell the March 15s going out 1 month. They're trading about 45 cents. So, and now you could do that. And then hopefully if everything sits here, or let's say the stock, those calls go out worthless, you can rinse and repeat, do that again. Obviously, nothing's ever the same every month. It's going to be different vol levels, different strike levels, all kinds of things. But let's say for the sake of argument, we could repeat that same level of out of the money call with the same relative amount of premium. Now you've done that throughout August. So at the end of the day, you add it all up, your net outlay is going to be not quite nothing, but pretty close to it, around 30 to 40 cents. Again, that's just a very optimal example. Those premiums are going to fluctuate. Maybe you get a big move in the underlying, your stock gets called, all kinds of things can happen. But it's just a real world example of that, which also brings you to the main con of this strategy. It's called the fig leaf for a reason. You're only partially covered. Remember, in a covered call, you have the stock to get called away. Here, you do not. You just have a long-term in-the-money call. So if you blow through your short call strike, then you're going to have to do something. This is not a set it and forget it strategy. You have to pay attention to it. As you start getting close to that strike, it's probably going to behoove you to roll it or close it out. You have to roll it, you have to close it out, or you have to deliver the shares, one or the other pretty much. So you don't want to go exercising that long-term in-the-money call and then buy the stock that way because you're giving up all that time premium. Obviously, that's a money-losing deal. But you're going to need to deliver something. So just bear that in mind. Jermal, what are your thoughts on this flavor of stock substitution? Kind of jazzing it up a little bit, taking the long-term call and then selling monthly or probably in the modern market, even more apt weekly calls against it, Jermal.
My initial thoughts are, Mark, you got me hungry because you mentioned Portillo's. Now I'm thinking hot dogs and chocolate cake.
It is right down the street from the studio.
I don't know. Yeah. I actually, it's funny you mentioned this strategy. We actually call that a poor man's covered call, going further out and having the long in the money call further out, whether it's a year or like, August or something like you mentioned. And then we usually try to find something within 6 months of time. So that I think your example is perfect when you have March versus August there. To sell that upside March against the longer term August call. So I actually like that. I actually have a couple of these right now myself in my longer term account. And it typically what ends up happening is you get the longer term call on, right? Whether you did it via stock substitution or you just wanted to have that longer term call in a leap situation. And you ride that leap call for a while, right? Because you just felt like the stock was going to go up anyway, which works out great. And then eventually you find an upside call and like you say, in a 6 month situation, 6 months further in situation to sell against it. And sometimes if you're lucky, you can sell that upside call for probably a similar value to what you initially bought that call in further out month that you wrote out. So it's just a perfect situation all around. But I'd be remiss in mentioning if like you said, I think you mentioned this at the outset, and I'd mention it again. If somebody does have these longer term stock positions and they want dividends, that's of course, like you said, that these situations that we mentioned above might not be right for you.
Dan, the last word is yours on this. What are your thoughts on this? Call it what you will. Synthetic covered call, fig leaf, poor man's covered call. So what are your thoughts on this approach?
I like it under the right circumstances. I don't use them all that often, to tell you the truth, mainly because, I do a lot of covered calls and cash cured puts in for my investments. The times when I want something like that, but more like as a trade, I don't know. I tend to do bull call spreads, which are not necessarily universally better than the poor man's covered call or anything like that. The things about them is the adverse things about them, which are not terrible, but it's just something we haven't talked about yet, are one I alluded to earlier, is that when you go deeper in the money further out in time, the markets tend to get a little wider. A, and then B, if assignment occurs, which most of the time you can avoid until you get that one big unexpected gap and get an early assignment or something like that. Assignment it's not the end of the world, but it can be a little bit problematic. Like, oh crap, now I've got short stock here. I got this margin. I got to buy it back. Oh, there's an extra commission I didn't plan on. Not that that's the end of the world either, but I don't know. Covered calls, they do a lot. Debit call spreads, they do a lot. Poor man's covered call, which is sort of a hybrid of those two, I do sometimes.
All right, and this next flavor of the onion, listeners, I'm going to let Jermal lead on this one because this is not my huckleberry. I was teasing Mike on the show last week that you tasty folks love to coin an options phrase, and he's like, oh yeah, I got another one for you. How about the zebra? So we touched on it a little bit last week, but it seemed like a good time to go into this. Jermal, what are we talking about? What the heck is the zebra? Give us an example, sir.
I thought it was funny you had this on the show. Listen, you guys know I started trading at a prop firm, right? And so I wasn't necessarily a retail type of trader. And I've been at Tasty for 4 years now. I'd never heard of this until I came to Tasty. I was like, what the heck is this? But it is a thing, buying two in the money calls and selling an at the money call, zebra. I actually don't even remember it's an acronym. It's like zero extrinsic, blah, blah, blah. You guys can look it up. Google never fails. But if you just Google zebra and Tasty, you'll find out all the information. But the intent is to eliminate the extrinsic value while you're getting long in any instrument that you'd like to get long via options. And so it's more near term. It's, again, it's another way to get long, and it's really interesting, and it actually, helps sometimes, right? So again, I don't really trade them a whole ton, but they're interesting nonetheless. And again, anytime you get long options, you don't necessarily want to have a tons of extrinsic value, and this helps with that.
Mr. Dan, do you recall our discussion out here of the zebra from last week, and any updated thoughts on it, sir?
No, basically everything I said last week, which is basically agreeing and with Jermal, because we had very similar experiences in the trading business. Now that I think about it, or now that I remember it. So yeah, it's something I could imagine using at some point. I don't probably haven't done that yet. At least not decisively intentionally, but who knows? Every now and then I get some creative bee in my bonnet and make some sort of option strategy that I don't know the name of. But yeah, I don't know. Yeah, hey, they all have a use, right?
They all do indeed. If you want to look it up, as Jermal suggested, listeners, I'm looking at the Tasty site right now. They define a call zebra. You could do it both ways. A put zebra. We're going to focus on the call zebras because that's kind of in the realm we're talking about today. They define it, I should say, as a bullish back ratio spread, where we're buying two in the money calls and selling one at the money call to remove all extrinsic value and achieve 100 positive deltas. This strategy is like a married put. The most we can lose is the debit paid, and we have 100 shares of long stock profit potentials. There you go. A little bit different as well. We're not quite going out as long term. As Jermal said, it's a more near day. You could do this front month if you want and keep repeating it throughout the year. It's designed to kind of get rid of what we were talking about with our first example. In our first example, we had that $10,000 of extrinsic value that could go the way of the dodo. You don't want that if you don't have to. So this is a strategy to get around that. So again, here's just 3 examples off the top of our heads. If you go talk to 10 options traders, they will come at you with 10 different ways that they like to carve up the stock substitution onion. And again, if you're out there right now, you're looking at these broad markets, we've been selling off a lot lately in the S&P, and it's been a lot of vol on the screen. If you're a little bit dubious about these valuation levels, or perhaps of a main core holding in your portfolio, there's nothing wrong with scaling it back. Take some off the table, live to fight another day. At the very least, you're going to keep most of your upside and free up a lot of that capital that you can use for whatever you want. If it helps you sleep better at night, you can put it in cash. Whatever floats your boat out there. So this is an interesting time to be considering these strategies, which is, again, one of the reasons why I wanted to revisit it here today. So great. Who was that initial questioner here? That was Tatsu. So good job, Tatsu. You inspired 2 weeks worth of episodes. But speaking of you folks, let's get to you now. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, let's get down to business with your Qs and RAs. We also like to shine the light back on you folks a little bit. We have some fun flash polls and questions of the week going right now. We were talking about it on our option block show on Monday. We saw a big block of the 490 puts going up in SPY, expiring at the end of March for 28 cents, traded 150,000 times. We asked you folks, do you want to buy those? Are you a seller? Or do you prefer maybe slinging in the vol or crypto space? And 46.4% of you said you want to sell those. 35.7% say you're a buyer. We did some digging afterward. Looks like they went up as part of a size fly. So that shines a little bit different light on those. But 490 puts, it just leapt out to us. That's a pretty low level in SPY at the time. As of today, obviously, SPY at 595. So that's a long way to go in SPY by the end of March, listeners. Are you down for those for 28 cents? Would you be a buyer or a seller? Our actual question of the week right now, and I'm curious to get Jermal's thoughts on this as well as our duly appointed broker representative. It's hot. It's back in the headlines again. Schwab stirred up the big 24-hour trading debate. So it's our time for our annual check-in with you folks, the audience. Quite simply this time, should options trade around the clock? Heck yes, heck no. Or you're super hardcore. You don't want 24/5. You want 24/7. For frame of reference, we asked you this question about a year ago, and nearly 70% of our audience, 69.8%, said no. They don't want stocks and or options to trade 24 hours a day. Jermal, I'm curious, what are your thoughts on this hot issue once again? Do you think options should trade around the clock? Yes, no, or you're hardcore, you want 24/7? And then B, more importantly, which way do you think our audience is going?
Man, I would say, God, this is a good one. I would say yes, but only for a few things. Maybe just, Dow, NASDAQ, S&P, right? Maybe just for a few things, but not everything, not every stock. I think that's a little too much. And I think having a break is a good thing. I mean, can you imagine? Otherwise, all of us are just going to be in our basement trading all the time and never talking to our families ever. So I would say I would say yes, but for just a few things.
Mr. Dan, same question for you. Which way do you think our audience is going, and which way are you going? Heck yes, heck no, or you want full 24/7, forget 24/5?
Oh, yeah, I don't want full 24/7 or full 24/5. I don't know. I like it the way it is. You get a break if you're like super into it. I mean, hey, you can hedge with the stock overnight. You can still worry about it and stay up all night if you want to. But I think you make better decisions with a little break. I never actually considered the idea that Jermal brought up about like maybe it's just some products, SPX, or something like that. I never really thought about that, but I mean, I don't know. I mean, that could be a compromise, but I mean, they've already expanded the SPX hours.
Yeah, XPX is about, 70% of the way there already anyway right now. But right now our audience, it was decidedly negative. This went live on Monday. A couple of days later, it shifted a little bit. It's still more than half of you say no, but it's only 52.6%. It was north of 60 not that long ago. 36.8% say heck yes, and then 10.5% of you are the hardcores. You don't want 24/5. You want 24/7 out there. So I guess if you add those two together, the roughly 37 and 10, you're talking about 48% of you. So nearly half want the full 24-hour trading. So yeah, it's an interesting debate. Get over there at Options, make your voice heard. Speaking of making your voice heard, this one, Bill, you must have been listening to the show. I don't know. This is a very perfectly timed question. It came in literally minutes before we went live. And normally we put these in the hopper for a future show. We can get a chance. Our producers can review them. But they said, hey, you're going to talk about this. This might be a good one to talk about today. So this came right on the button, Bill. This comes from Bill Morse. I like his handle, New Day Caesar. I'll keep seizing that New Day, Bill. He says, hey, guys, long-time listener. First time sending in a question. Well, welcome, Bill, to the long-time, first-time club. He said, much thanks to Dan and the black-hatted one. Well, Dan and the black, that's the same guy. I think you meant me and the black-hatted one. But hey, I'll forgive you. You're a little hyped. I get it. You're a little psyched. For all your advice delivered so lightheartedly. I've tried a lot of strategies over the years, but I've settled in on a frequent covered call strategy, selling covered calls on both the underlying stock and leaps. Again, it's exactly what we were just talking about, listeners. Perfectly well-timed. Sometimes the same one a few times a week, depending on how volatile the underlying is. My question is about selling covered leaps. If you look at the stock like Intel, the math almost seems too good to be true. Again, we were just talking about this, Scott. He says, I can buy 100 shares of Intel right now for $2,350. And that is almost exactly, that was about exactly what the stock was when the show started. So again, you must have written this morning. And then sell the December 25 call for $400 or 17%. And he says, this is only 9 months out, not even a true leap. This is now I can sit on Intel for the rest of the year, collecting my dividends on the stock. That is another pro to having the stock versus our synthetic covered call fig leaf from before, listeners. If you have the fig leaf, you don't get the dividend. Just something to point out. Bill's talking about having the stock, in which case you do get the dividend. So an additional income stream for you. Because now I can sit on Intel for the rest of the year collecting dividends. If Intel goes up a lot, my sale price is capped at $25. It would sting to see Intel at 50, but I would still make 150 when the call was assigned for a total gain of $550 or 23% of the initial $2,350 in only 9 months. If Intel goes down a little, I consider buying back the call and doing it all over again. If Intel goes down a lot, I would buy back the call and wait for Intel to recover next year. It would have to drop 17% before I start to have a real loss. What am I missing? Sounds like an easy way to make over 23% in 9 months, plus collect some dividends and get the other guy's premium upfront and play with it for 9 months. Again, sounds too good to be true. Thanks, Bill. Bill, our producers pulled it out right before showtime, and your numbers are pretty much exactly right. Intel was at 23 double at the time, and those D's 25s were 390 at 395, so right around $4. So yes, you can do all this right now in the marketplace, listeners. And hey, you know what? This is the flip side of what we've been talking about for a while, this kind of meme speculative frenzy that happens in some of these names. You are seeing the plus side of this. Intel's obviously been subject to a lot of takeover rumors we talked about some very, very near dated upside call paper on Options Oddities not that long ago, playing in the weekly. So folks were expecting this to happen imminently. It hasn't really happened, but you're still seeing the residual juice out there in the call wing, which makes strategies like you're talking about here much more attractive than they would traditionally be. Jermal, a very timely question. He's talking about buying stock for the long term this time and then selling calls against it. He wants to know, is he missing something with Intel? Is this too good to be true, sir?
Too good to be true is there's always, that's the question I think we ask ourselves a lot in options trading, right? But the thesis is actually pretty straightforward. I mean, as you laid out, that actually sounds fairly good. I guess the only thing I'd say maybe missing is, the interesting part comes in when if Intel goes down a little, or if Intel goes down a lot, right? I mean, we don't necessarily know when those happen. And that's the thing. It could go down what you think is a little, you buy back the call, and then it actually ends up going down a lot. And then you're like kind of feeling stuck, right? And then you start thinking, well, do I buy more stock? Or did I buy that call back too early? That's probably the only thing that I can see where I'm poking holes in. But other than that, I mean, it sounds like they got a pretty good thing going there overall.
Mr. Dan, the last word is yours again, sir. What do you think of this Intel trade? Is Bill, is he missing something? Is it too good to be true?
Hey, did he give exact strikes and expirations again? I forget.
Yes, he said buy the stock at around 23.5 and sell the December 25s for around $4. So $400 a one lot.
December. Yeah. Well,
that's pretty much exactly where they are right now.
Yeah. Geez, yeah, man. That's not. I mean, I don't have a big complaint about that, really. Sometimes it's get
not bad, right?
Yeah, it's not. I'm like, should I do this? Sometimes you get these conceptual ideas of like, oh yeah, I like this stock. Maybe I'll do a call on it. Let's take a look. And then you look at it, it's like, yeah, it's a terrible trade. But yeah, this one, I don't know. I kind of like what I'm seeing, really.
Yeah, not a bad idea here, Mr. Bill. I think you gave Dan and Jermal. So our chat's liking it. We got Nichols saying, I like the Intel trade, so our chat's down for it. So I think a lot of people are going to be investigating Intel. Well done, Bill. Good job for your first question writing in after listening for years. All right, that music means we're coming up against it. Really quickly, if you want to go through the Intel example, but maybe in the way we were just talking about it on the show, using perhaps leaps instead. If, let's say, $23.5 was too rich for your blood, you could go out and, let's say, in our example, you buy the D's 20 calls. Now you're about $3.5 in the money, and that's $6.35 right now. Again, there's some juice baked in there. You could turn around and sell, let's go out to the 26 handle, March 26 calls. You're going out a month, upside is 26, so even higher than what he was talking about, the D's 25. You're getting 60 cents for that. Again, you could do the math, rinse and repeat. Everything's not going to be the same every month, obviously, but if we assume for sake of argument that it is, then you're going to get out for about $6.60, so more than the premium for that call over time. Again, you're going to get more during earnings times and less, all kinds of other things like that. So if the $23.50 outlay was too much for you, this is another way to go about it. Now, you're not going to get that dividend that Bill was talking about. So if that's a lot for you, then maybe this is something to consider. But if you want to do this strategy with a little less capital involved, that's another way you could go about it. Again, if these rumors prove to be true, Intel goes to $50, you're going to definitely miss it with the Bill version of the December. If you're doing a little bit more nuanced, you're writing monthly or weekly calls, you might get lucky. You might be able to roll and adjust in time to catch the upside or just take the covered call off. That's another reason why I like the near-dated stuff. But again, something else to keep in mind, just another way you could carve up that onion. All right, great stuff here. Mr. Jermal, thanks for joining us today. And if folks want to check out what you and the crew have cooking over there in Tastyland, where should they go? What should they do?
You can go to YouTube, tastylive. We have a ton of content on there. We have our daily shows on there. My show personally is at 1:45 to 2:15 every day of the week except for Wednesday. And then I also do a show on the network, Futures Power Hour. And these are Central Times, by the way, noon to 1 p.m. Tuesdays and Thursdays. And, of course, you can go to the Tasty Live webpage. My show is called Engineering the Trade. It's also called Futures Power Hours, another show I do. So, yeah, check us out anytime. And, of course, my name is Jermal Chandler, Jermal. I hated it growing up, but it's turned out to be a unique way to find me. And so you can find me anytime, all my socials and anything on Google as well.
Give them a follow over there. I didn't know you did futures as well, Jermal. We just added a futures show to the network towards the end of last year. In fact, that will be coming up almost immediately after this program. Maybe we'll have to get you on, talk some crude and gold one of these days, sir. What do you say?
Anytime, sir. You know I love the show. I'm a big fan. So, yeah, anytime. Just let me know.
In the meantime, you know where to find those folks over there at Tasty. Maybe you're intrigued by the Zebra. Type Tastytrade and Zebra into your browser. That'll get you right to the Zebra. From there, you can click through, kick the tires, and light the fires. We'll have a lot of tasty folks joining us here on the show for a little bit. So we'll get into all sorts of fun and interestingly named strategies, just like the zebra, to come. But check them out over there at Tastytrade, or what Jermal and the crew are doing over there at tastylive. And Mr. Dan, if folks have more questions about stock substitution, or maybe they have more interesting trading ideas like our boy Bill here, where should they go? What should they do?
Yeah, well, I mean, I usually talk about Market Taker, but since we were talking about stock substitutes and covered calls and such, I also have our new Substack, which is Wealth Building with Options.substack.com. I know it's like really long, but they're all pretty simple words, so it's not, it would be hard to mess it up. Wealth Building with Options.substack.com.
There you go. Check them out. Wealthbuildingwithoptions.sub. Don't forget the Substack part.com, listeners. A lot of people hanging out on Substack. Dr. Vic's hanging out on Substack. Now everybody's got a Substack, it seems like, these days. So check it out over there. Substack. Everything old is new again. Substack coming back hot, listeners. So intriguing stuff. That's going to do it for us on OBC, but that's not going to do it for us on the network today. Back again in a little bit to talk futures. I'll be joined by the folks from Iron Beam to break down all the hot action in the underlying going up right now, listeners. And then after that, if that wasn't enough, we come back one final time exclusively for all you pro cats hanging out in the secret club to have another great pro Q&A session. If you haven't, I see some questions coming in our live chat. If you haven't gotten your questions in, get them in soon. Those are usually pretty popular. So that'll be coming up, I believe, at 3:30. So a full day here. Then back again tomorrow, of course, for our usual doubleheader. The option block with our friends over there at SIBO at noon, followed by This Week in Futures Options with our friends over there at CME at 1:30 p.m. And after that, Friday, we come back for another doubleheader. Vol Views at noon. I believe we'll be joined by our good buddy, Mr. Matt Amberson. Been on this show many times, a.k.a. the Oracle of New Hampshire himself. He'll be talking some wild vol. And then he's doing a doubleheader as well. He's coming back for Options Oddities to talk exclusively to you pro folks because he loves it so much. Last time he was on, we were talking about these quantum straddles. It was a wild time. Who knows what we're going to have in store for us this week? Head on over to the pro, theoptionsinsider.com/pro is the place to get past the velvet rope and join us for that. Then we're back again next week all the way through to next Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
Old trading walks into a bar. New trading raises it. Unlike some guys, Tastytrade puts traders first. Maybe you're the type to hunker down on your desktop for hours. Maybe you breeze by on your browser. Or maybe you just need that top-rated app right by your side. However you do it, Tastytrade's got the most advanced tools you need to tackle stocks, options, futures, and more, all in one place. Chart your heart out with over 300 indicators. See opportunity differently with interactive curve analysis. Use backtesting to learn from the past and plan for the future. The platform is only the beginning of better trading. You'll also find low pricing, lots of education, and backup from a support team that really gets how traders trade. It's no wonder Investopedia named Tastytrade the best broker for options in 2024. Genius loves company. Go to tastytrade.com/ride with us and see for yourself. Tastytrade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.